All right. Hello, I'm Tanya Hamilton, and Kelly Pocock is here with me. We are Urban Haven Group, and today we are hosting Jenn McLean from Mortgage Pal to talk about when not to go to the bank for your lending. We've also had the privilege of being joined by Jenn a couple of other times to talk about the Burr method as well as the Smith maneuver. I'll post some links in this video so you can check those out too, because both were absolutely phenomenal sessions. But yeah, I'll take it away, Jenn.
Awesome. Thanks, Tanya. Yeah, I'm having fun doing these little talks because I think it's fun to highlight and find different ways for finding unique lending solutions for people. So today I'm just going to outline the benefits of working with a mortgage broker and highlight some of the reasons why a borrower might not be able to get a mortgage through the bank, and then what lending options are available to them instead. And I'll go over two specific examples. One is borrowers who have had some credit issues in the past. And then for all of our self-employed borrowers, as they do tend to be the most common applicants who get pushed out of the banks altogether. Okay, so yeah, first of all, why would you work with a mortgage broker when you could simply just go to your bank branch where you've been banking with your entire life? Well, mortgage brokers work with a variety of lenders, including the banks, credit unions, private lenders, and they give you access to a wider range of loan options that you might find by working directly with a single bank. Brokers provide personalized guidance throughout the mortgage process. We offer expert advice that's tailored to your specific financial and home buying goals. And we can help navigate the complex mortgage products and find the best fit for your needs. Brokers have the ability to negotiate on your behalf to secure competitive interest rates and terms. With our knowledge of the industry and relationships with lenders, we can often obtain better deals than individual borrowers who are just trying to negotiate with banks themselves. Mortgage brokers streamline the mortgage application process by handling paperwork, coordinating with the lenders, and ensuring that all necessary documents are submitted accurately and on time. This can save a borrower time and reduce the stress associated with securing a mortgage. And working with a mortgage broker can potentially save you a lot of money in the long run. Brokers may be able to find mortgage products with lower interest rates, reduced fees, or waived costs, ultimately helping you save on the overall mortgage expenses. Okay, there's lots of different types of lenders. So I'll just go over the different ones that are available. The ones we all know mostly are the big banks. There are familiar giants of finance. So banks are known for their stringent lending criteria. So they mostly cater to low-risk borrowers who are seeking stability. However, their product range might lack the flexibility some borrowers need. Banks tend to be most popular among borrowers looking for reliability and a full range of banking services. Now there's monoline lenders. They focus exclusively on mortgages. They offer competitive rates and flexible terms through the broker channel. These are ideal for borrowers who are looking for specialized mortgage solutions without the overhead of a traditional bank. Monoline lenders are best suited for those who prioritize mortgage customization and efficiency. I personally love the monolines. Then there's the alternative lenders. These are the lenders that fill the gap for those who don't meet those traditional lender standards, and they offer solutions at higher rates, but with a supportive approach to improve a borrower's financial health. Alternative lenders are often a good fit for borrowers with unique financial situations or those who are rebuilding their credit. Private lenders are individuals or companies lending their own capital. Often they have more flexible criteria due to their lack of regulatory oversight. While typically more expensive, private mortgages can definitely be a crucial solution for those who are unable to secure financing through traditional means. Going private is a great option for borrowers who are in urgent need of financing or those who are currently unable to meet the criteria of other lenders. And then there's credit unions. This is where community meets finance. They offer competitive rates and a more personal touch and provide a more intimate alternative to big banks, especially for those valuing community focused banking. So credit unions are very popular among borrowers who prefer a personal relationship and a community-based banking experience. And mortgage brokers work with all 5 of these different types of lenders. So when it comes to financing a home, many people immediately think of the big 5 banks or the A lenders or prime lenders, and also including big name wholesale and monoline lenders. But it's really important not to overlook the important role of these alternative lenders or B lenders. Think the smaller, more niche alternatives and private options, and they play a big role in the mortgage landscape. So B lenders cater to a diverse range of borrowers, those with lower credit scores, new Canadians who are building their credit history, or anyone who's needing a little more flexibility than the big banks offer. They might charge slightly higher rates, but their ability to accommodate unique financial situations can make them a smart option for many borrowers. These lenders can be a lifeline for those who might not qualify for A lenders, providing short-term solutions that allow you to improve your financial standing over time. Or in some cases, you might be best suited to stay with a B lender for the longer term, making them the best case solution for you. So if you're navigating the complexities of home financing, definitely don't shy away from exploring the benefits that B lenders can offer. They might be the key to unlocking your path to home ownership. Okay, so let's talk about debt. I've said it before and I will say it again. In today's economy, struggling with debt doesn't make you a failure. It makes you a human. We've got rising living costs, sky-high consumer prices. Many Canadians are finding themselves overwhelmed by debt through no fault of their own. So here's what you need to know. Taking control of your debt through a consumer proposal or a bankruptcy isn't giving up. It's actually taking charge of your financial future. And while these options do impact your credit temporarily, they're not permanent roadblocks to home ownership. The reality, most mainstream lenders will consider mortgage applications just 2 years after completing a consumer proposal or a bankruptcy, and often at standard rates. So during that time, you can focus on rebuilding your credit, saving for a down payment, and creating healthy financial habits without the weight of overwhelming debt on your shoulders. Addressing debt head on isn't closing doors. It's actually clearing a path to open new ones. And with the right guidance and patience, you can transform a debt solution into a stepping stone toward your home ownership goals. Finding the right lending solution for people with past credit issues depends on a number of factors. So for a previous consumer proposal or a bankruptcy, we're going to look at how long has it been since that was discharged, and what was the reason for the claim? Has there been more than one? If you've had a double bankruptcy, there's pretty much no chance you're going to qualify for a bank mortgage in the future. That's just the way it is. But there's alternative lenders who will definitely consider a double bankruptcy if the story makes sense. If you have high credit utilization, we want to look at the reason for that. What is the dependency on credit coming from? And if you have excessive debt servicing ratios, meaning you've got higher debt than what will allow you to qualify for the mortgage you're looking for, well, that's where alternative lending solutions can really help bridge that gap. While you work on reducing your credit utilization, you can qualify with a lender that's going to offer more flexible debt servicing ratios. Or if you've got a low credit score, if your score is under, let's say, 600, you're not going to be able to qualify for a prime lending mortgage. So we're going to be looking at alternative lenders while we work on a solution to increase that score and eventually transition you onto the A side of lending. Okay, then there's entrepreneurs. So they're constantly faced with this easy solution of just pay yourself more as a means to qualify for a mortgage with a bank or a prime lender. These lenders do have strict guidelines and policies that don't always align with the self-employed borrower's finances. They need to make more on paper to qualify for the mortgage that they need at the best interest rates on the market. But does the cost to claim more income on your taxes outweigh the interest rate savings you get with a bank versus an alternative lender? Flexibility and control of your tax exposure are some of the biggest perks of being your own boss. You can decide how much to pay yourself and therefore how much you're going to pay in income taxes. And of course, the more you make, according to what you file on your annual taxes, AKA on paper, the more income taxes you're going to owe. So while having more documented income gives you more borrowing power, it does cost you more in taxes. And if you don't qualify at a prime lender, there are always alternative lenders that have more flexible guidelines and love to work with entrepreneurs to get them approved. The interest rates are higher with B lenders, no question, maybe 0.5 to 1% higher than the bank, depending on your specifics or your mortgage needs and credit profile. So ask yourself this question: does paying more interest on your mortgage interest rate cost you less than paying yourself more in taxes? If the answer is yes, then maybe simply paying yourself more isn't actually the best solution for you. So there's different types of mortgage programs for business owners depending on their specific business. So for business owners who pay themselves dividends or are a sole proprietor whose net business income is close to being enough to qualify for the financing they want, some lenders will allow a 15 to 20% gross up of those numbers, which can often provide the income boost that we need to have the financing approved. So this is the type of mortgage you'd be looking for with the bank. We're going to use a 2-year average of your net business income and potentially add 15 to 20% to that. So for these programs, you do only need the minimum down payment, and it can be insured with any of the insurers. Then there's the stated income or the Alt-A programs for business owners. So this program allows you to state your income, and as long as it's considered reasonable by the lender and the insurer, they're going to approve your financing. So this program isn't cut and dry. It's very case by case. It's highly dependent on the story behind what you're declaring or stated as your income. For this program, you need a minimum of 10% for the down payment, and these mortgages are insured. They're default insured by the CMHC or one of the other two insurers up to 35% down. So you are paying the insurance premium on a bigger down payment. And also the insurance premium is higher than a standard insured mortgage. So there is going to be a higher cost of borrowing for this particular type of mortgage, but it still keeps you in the prime lending sphere. And then there is the third option, which is the one that I tend to use the most for my business owners, the bank statement programs. So this is where you can use 6 to 12 months of business bank statements to effectively show how much income your business is producing. And this is based on deposits, less your fixed expenses. And we're going to use this number to qualify for the mortgage financing you need. So this is definitely an alternative mortgage solution. The prime lenders do not do this. So you will need a minimum 20% down payment for this program. But as I said, this is the one I use the most for business owners because it is much easier to qualify for the mortgage that you need using this type of program. And you're going to pay a little bit more in interest, but obviously, it's not requiring you to make any fancy accounting changes with your taxes. So this is definitely a great option for borrowers who are self-employed, as long as you've got that minimum 20% down payment. So how does a borrower figure out which lender is the best option for them? Well, this is where the mortgage broker plays a crucial role. It's our job to weigh out the strengths of a client's file, determine which bucket of lending they belong in, which is prime, B lending, or private, and then choose the most suitable option for that borrower. At any given time, market conditions can alter the mortgage industry in massive ways. So when we're in an economically uncertain time, the nuance between how different types of lenders react may impact your bottom line in a big way. In times like these, having options is critical. So the big banks typically have the lowest risk tolerance of all the different lender types. And sometimes it feels like trying to fit a square peg into a round hole. It's just not going to fit. Lenders are always battling for your business. At times, we'll see major banks fight hard to keep their market share. We might see them make more exceptions for unique credit and income scenarios. while other lenders will also be vying for business by offering specific programs tailored to the unique situations, such as business for self programs or credit repair programs. This competition can benefit borrowers by way of lower mortgage rates and increased mortgage flexibility. Different lenders handle uncertainty different. Some tighten their lending criteria. Others offer longer rate holds, maybe up to 120 days. Many adjust their prepayment privileges. And some lenders become more conservative, requiring higher down payments, being pickier about property types, looking more closely at employment stability. And others will maintain their standard policies, seeing opportunity where others might see risk. So this variety in lender approaches is actually good news. It means there's more options for your situation, there's a better chance of approval, and there's the opportunity to find the right fit. The key is working with a knowledgeable broker who has access to multiple lenders and understands all of their differences. At the end of the day, you might end up in a mortgage with one of the big banks, but if the mortgage transaction is facilitated by a mortgage broker who knows you, your financial situation, and your goals, then you can rest assured that you're in the right mortgage for your needs at that moment in time. And that same mortgage broker will be there to guide you for as long as you have a mortgage. And that's it today. That's all I wanted to share. But yeah, again, if you've got any questions or want to reach out, I know that Tanya and Kelly will provide contact info. And yeah, I'm happy to walk through scenarios with anyone who might be a little bit more unique.
Awesome. Thanks so much, Jen. As Jen mentioned, we'll post the contact information for Jen in the description. And if you have trouble finding it, you can reach out urbanhavengroup@gmail.com, and we will put you in direct contact with Jen. All right. We'll see you next time.
Thanks.